Welcome to Learned Be Accounting. Today our topic is interpretation of financial statements, ratio analysis. So in this topic we're going to be covering a lot of things. So I feel like even if you're an accounting student, even if you're not doing anything related to accounting, right, we've definitely come across the word financial statements. No. Financial statements are like a report or a book of all the transactions of they show the financial position and the financial performance of the business. They are used to portray the financial position and performance of the business, right? So in financial statements are very, very important to accounting information users. So there are people who make use of these financial statements. So people that make use of these financial statements, we have the investors, we have shareholders, we have lenders, we have creditors, we have customers, um we have employees, right? So now, these are some users of this financial statement, and for them to be able to make good decision from the financial statement, they need to understand it. They need to be able to interpret this financial statement. Now, there are various ways of interpreting financial statement. The main way we can say is through ratio analysis. So this is where we come about ratio analysis. Now, ratio analysis is a way of analyzing this financial statement using accounting ratios, right? So ratio analysis is analyzing financial statement using accounting ratios. Basically, ratio is when we talk about ratio, we talk about the relationship between two variables. So when we talk about ratio, we talk about a relationship between two variables. So now, for you to fully understand a particular figure in the financial statements, for example, let's say profitability, let's say the profit now. So let's say now I'm an investor and I want to invest in a company, and then I have two companies at my doorstep, and they are telling me that okay, my A tells me that their profit is $50, and then B tells me that its profit is $100. So now, if I'm not allowed to make a decision based on this figure. Like if I make a decision based on just these two absolute figures, it will be wrong. It means that I'm not being diligent enough before I invest, and I'll probably be investing wrongly, right? Because I'm not making a well-informed decision. I cannot make a decision based on this. For me to make a decision if I should invest in either A or B, I have to compare these figures to other figures in their financial statement. So I can decide to compare these figures to the capital employed, so how much was actually employed into the business, or I can compare these figures with their sales, right? So now if A tells me that okay, their sales for A is 500,000, and then Bill's $500, and then Bill tells me that their sales is also $500, right? So now based on this, who would you say I would want to invest in? I'll obviously pick A, because for the same amount of sales they are getting more profits, right? So I can, based on this, I can come to a conclusion that B is a more efficient company because they know how to manage their costs. Because if they are getting the same revenue, and then because you know that for you to get profits, profit is equal to revenue minus costs, right? So if they are getting the same revenue, and then but B is making a higher profit, that means B is managing their costs better than A. Does that make sense? So now I make my decisions on whether I should invest based on relationship, right? So that's where ratio analysis come in. So you make ratio analysis is based on comparing or finding the relationship of variables in order to make a good understanding of these financial statements. So now we are looking at categories of ratio analysis. So when we talk about categories of ratio analysis, there are 5 categories of ratio analysis. We have the profitability ratio, we have the activity ratio, we have the liquidity ratio, we have what we call solvency ratio, and then we have the investor ratio. You always know that there are 5 categories of ratio analysis: profitability, activity, and investor. You might, if you've not heard of activity, you might have come across the word efficiency. So this is either called activity ratio or efficiency ratio. And so when we talk about profitability ratio, profitability has to do with the profit, right? So we are trying to find the relationship, interpret the profitability of the company. So when we're talking about profitability, this is the issue has to be issues about profit, knowing if the company is being profitable or not, right? When we talk about activity ratio or efficiency ratio, we're trying to figure out if this company is being efficient. So when we say efficient, how efficient are they in the activities they are carrying out? Okay, is turnover going smoothly? How often do they collect their debts? How do they pay their debts? Like, they are basically their efficiency. Talk about liquidity. Liquidity talks about the ability of a company to pay up short-term loans. So when we talk about liquidity, we talk about short-term loans, ability of a company to pay up short-term loans, or maybe working capital. Has to do with like the company's working capital basically. Then when we talk about solvency, another name for solvency can be gearing ratios. You may have come across the word gearing. So gearing basically talk about long-term debts. So when we talk about solvency ratio, this we talk about their company's ability to cover up or pay up long-term debts or long-term loan, or the percentage by which the company is geared. So when we say geared, it means the amount of debts by which this company is running on. So we know that, for let's just throw more light on solvency. We'll still go more into it when I'm talking about it. But under solvency, we are talking about, we know that in a company is the two main sources of capital is either through equity or through debt, right? So now these are basically the two main sources of capital, the capital employed into a business. So now solvency, when we talk about gearing, the gearing part of solvency, we mean how geared is this company, what percentage of this company is mostly run on debt, right? So when we get there, we'll talk about the formula. And then when we talk about investor ratios or investment shareholder ratio, this talk about the ratio that an investor will want to know for them to invest. So it talks about the investors holdings in a company. So these ratios, it basically helps the investor to understand if they should invest in a particular company or not. So right, so let's so first now I want to talk about profitability, and then we'll talk about the different ratios under profitability. So profitability ratio. So there are so many formulas. There's so many formulas under profitability ratio, right? But I'm going to talk about 3 main ones, and these 3 main ones, like, they are the main ones that are usually asked. And then if you are given any question and you're asked to calculate profitability ratio, once you write these 3 main ones, they are like the main ones that are being sought after, right? So the very first one I'm going to talk about is gross profit margin. So when we talk about gross profit margin, the formula is calculated as gross profit divided by sales times 100 times 100%. So gross profit divided by sales times 100%. So now this is basically trying to find the percentage of profit to sales, right? The percentage of gross profit to sales. So for example, in the company's financial statements, it was given that sales was, for example, $500, and then cost of sales for that company was maybe $350, right? So then if you are giving this, that means the gross profit for this company would also be given as $150. If you are giving this, the gross profit is the profit from the direct sales of that particular product, right? So it's just the sales over the cost of producing that particular material that is sold. This is which what we have here. So gross profit being this. So now an investor should not gauge the ability to invest in this company based on this gross profit alone. No, they are to use the percentage of this gross profit on the sales. So given if we're supposed to do the gross profit margin for this now, this would be 150 divided by 500 times 100%. And this gives a percentage of 30. So this is 30%. So now this says that this basically means that the company made 30% gross profit from these sales. So 30% profit on sales, right? There was from 500 sales, there was 30% profit on these sales. So now when we talk about gross profit is made up of, like I said, sales minus cost of sales. The percentage of gross profit margin is mainly based on the ability of the company to maximize revenue and to minimize costs. So when we talk about profitability, it's mainly based on the ability of the company to maximize revenue and minimize costs, right? So So now this gross profit, since it is made up of the sales minus the cost of sales, this means that the company was able to, and they got a 30%. So the company was able to maximize sales to this extent, 500, and minimize cost to this extent. So assuming we had a different company, right? And remember I said that ratio analysis is not done alone, it's not done absolute. So even after getting this 30%, you still have to compare it to something else to know if the company is doing good or bad. So now if this company had a previous year gross profit of maybe 50%, or yeah, maybe the year before that was maybe 60%, I mean the year before that was maybe 70%, and now they make a 30% profit this year, we can see that this is bad because there was a drop in their profitability, right? But assuming this company in previous years was only making like 5% or 10% profits, and then this year it makes 30% profits, we can see that this is good because there was a rise in profitability. So ratio analysis is not done just to get the absolute value. This absolute value is usually compared. So you can compare these ratios with either their their past years ratios, or you can compare it with their industry ratio. So for example, if they made since they made 30% this year, and then the industry ratio is an average of maybe 60%, this is seen as bad because their percentage is way below the industry ratio. And then if an investor is comparing this between industry company A and company B, and company B after calculation made a profit of maybe 40%, you can see that company A is not doing up to the way company B is doing. And then for example, and for instance, they are the same type of company, the same things they produce, we can see that company B is doing better, so the company will want to invest in company B. So ratio analysis is not just done on absolute value, right? It is done on the comparison. They relate the value to another value and know, okay, is this actually better or worse? Either relate it to the past year value or you relate it to the industry ratio, depending on the question you are given. So the next ratio under profitability ratio, we have the net profit margin. So this net profit margin is equals to net profit divided by sales multiplied by 100%, because this is also supposed to be in percentage. When we talk about net profit, we mean profit after tax. So net profit here. So when we talk about profit after tax, we know that in the company account of the financial statements, you usually see things like profit before interest and tax, see profit before tax, before you now see profit after tax. So now to calculate this net profit over sales or net profit margin, you use your profit after tax. So now this net profit margin has to do with the ability of a company to be able to maximize their revenue, minimize their costs, and also minimize their operating expenses. We know that to get net profit after doing your revenue minus your cost of sales, you also have to minus your operating expenses. So I mean, so if a company's net profit is high, it means that the company is able to maximize their revenue at the same time minimizing their cost and their operating expenses. And then again, whatever percentage you get from this calculation, you compare it to either previous years or the industry percentage. The last ratio we're going to look at under this profitability, are going to look at the return on capital employed, ROC. All right. So when we talk about return on capital employed, the formula is your PBIT divided by your capital employed times 100. Okay. So now this basically talks about the return on profits from capital employed. When we talk about capital employed, we mean capital invested in the company. So now there is a controversy on what we categorize as capital employed. So we know that capital employed is not directly given in our financial statements. In the financial statements, we have we have the assets, we have liabilities on the other side, and we have the equity, right? So capital employed is not always directly given. So there comes an issue in coming to realize what capital employed actually is. So I'm going to teach you an easy method on how to know capital employed so you don't confuse it in the exam hall. So when you're looking for your return on capital employed, which is your return on profit on the capital employed, you're going to write your accounting equation like this. Assets is equal to liabilities plus equity. So now we're going to break this down. So when we talk about assets, write out the accounting equation, which is assets is equal to liabilities plus equity. So we know that liabilities has to do with non-current liabilities and then current liabilities, which is like long-term liabilities and short-term liabilities. So I'm going to write long-term liabilities plus short-term liabilities plus, or rather, let me write long-term liabilities plus current liabilities and then plus equity. So capital employed involves all the capital that not due in the short time. So now these assets, you're going to move this capital employed, this current liabilities to this side. So assets minus current liabilities is equals to long-term liabilities plus equity. Right. So now this asset that has to do with non-current assets plus current assets minus current liabilities is equals to long-term liabilities plus equity. So this is capital employed. So the assets, the total assets minus the current liabilities that are due in a short period of time. That is the capital employed. When you do this, this basically equals to net assets, or the long-term liabilities plus the equity. So in given in a question in a financial and you're given a financial statement, so any of these, you can see the equals to sign, means that this is equals to this, right? So any of these will be used as capital employed. Either you use the total asset minus the current liability, or you use the long-term liability plus the equity, which is equal to capital employed. So now when you get this, the percentage of this is seen as so for example, if after doing this a percentage is 50%, it means that there was a return on 50% profits for a particular amount of capital that was employed. So if capital employed was 100,000, was 1,000, and after calculating with your profits, then you had a profit of 500, right? So you have a 50% profit. So it means that you have a 50% profit for the capital employed in this business, right? So that's all for profitability ratio. We're going to move on to activity or efficiency ratio in next part. So now, so we're going to look at activity ratios. So activity ratios are ratios that measure the efficiency of management in the use of business assets. So if activity ratios are ratios that measure how efficiently management use business assets. So right. So these are usually ratios that relate sales to assets, right? They usually relate sales to assets. So another name for these ratios can also be turnover ratios, or you can also call it efficiency ratios, like we said. So now the first ratio that we're going to be looking at here is debt collection ratio. No, debt collection period. Sorry. So debt collection period, this is basically the ratio that measures how long it takes for a company to collect their debts, right? How long it takes for a company to collect their debts. Debt collection is in the name. So the formula for this is receivables over credit sales by 365 days. So this formula is usually calculated in days. That's why we write in 365 days. But for example, you're asked to calculate in months or weeks, you'd rather use 52 weeks because they are 52 weeks. And or if you are asked to calculate in months, it's better you have to use 12 months. You have to use 12 because they are 12 months. But on a normal basis, even if it's not given, it is usually calculated in days, so you are usually required to use 365 days. So now emphasizing on this credit sales that is written here. So you know that usually credit sales is meant to be different from normal sales, because credit sales is the amount of sales that are actually on credit, right? But on a normal basis you would just be giving sales. So in the exam hall you're just required to use the sales figure given. But if you are when you are stating the formula, you have to state it's receivables divided by credit sales. But in a in the exam hall, when they give you a financial statement, they will most probably not give you this credit sales. They will just give you the sales in your statement of profit or loss. So you have to just use the sales figure directly, and then when whatever you get, these answers is usually in days. So just do x days, and when after solving, your answer is going to be in days. So the next formula we're going to look at is inventory turnover ratio. So we're going to look at inventory turnover ratio, and the formula for inventory turnover ratio is average stock divided by cost of sales. So you just write this as average inventory divided by cost of sales multiplied by 365 days. This formula, the answer is also given in days, right? So in this formula, what you're basically trying to find out is the number of times average stock converts into sales. So this formula is also in days. The answer is always also given in days. So if you're asked in weeks, you know you're going to have to use 52, and if you're asked in months, you're supposed to use 12. So this formula basically is just to find out it takes for inventory to turn over. So rather there's also going to be an inventory turnover. So I think rather we should call this formula turnover period. Inventory turnover period. This has to do with how long it takes the inventory to turn over. The next formula we're going to be looking at is the creditors payment period. When you hear the word creditors payment period, um it can come to you as how long it takes us to pay off our creditors. So remember that when we looked at debt collection period, this is how long it takes us to collect our debts. How do we make these debts? Through credit sales. So when we sell on credit, how long does it take us to collect those debts that we are selling on credits? Do you get? So for this case, since we're looking at creditors payment period, we can guess that how creditors payments is brought about is credit purchases. So when you purchase things on credit, how long will it take you to pay off those amount of money that you are owing the credits? So this is going to be trade payables divided by credit purchases multiplied by 365. Again, because this is in period, we want to know how long it will take us to make creditors payments, to make payments of the amounts that are being owed to creditors, how long it takes us to pay our trade payable. Basically, just like we said earlier, ratios are not just calculated for the sake of their absolute figure. No, they are calculated in order to use their relative interpretation, right? So even after calculating our debt collection period, or our inventory turnover period, or our creditors payment period, we don't just use the amount of days as okay. For example, if we calculated our debt collection period as 50 days, we don't just use it as okay, this is good or this is bad. You have to compare it, relate it to a particular figure, or relate it to another ratio to know if that is actually good or bad, right? And also for activity ratios, you don't conclude if it's good or bad. So like I said, you just state. So when you, for example, if you're making a comment based on the activity ratios after calculating for these three different ratios, you just be like, it takes this amount of days for the company to collect their debts. This amount of days is better compared to the previous year. So you, when you calculate this ratio, you're either comparing it to the previous year of that same company or the industry rate, right? So if it takes the industry 50 days to collect their debts and it takes this company 100 days to collect their debts, you can see that this is going to be bad because the company is going to have liquidity issues. It's not going to have enough money flowing in. So now we're going to use these three formulas to explain what we call the cash conversion cycle. Cash conversion cycle basically means how long it takes a company to convert inventory to cash through sales. So how long it takes a company to convert inventory to cash through sales. Now you calculate conversion cycle using the three formulas that we've talked about under this activity ratio. So the three formulas are the inventory turnover period, the debt collection period, and then the credit collection period. So the formula for this cash conversion cycle basically is going to be inventory days, receivable days. You find the total, and then you're going to less the payable days. So this is called our cash conversion cycle. So this basically is the number of days it takes for a company to convert its inventory to cash through sales. So this is the number. So whatever days we get here, because we know that inventory days, this is the amount of days it takes for inventory to come in. Receivable days, this is the amount of days it takes for money from credit sales to come in. Then this amount of days it takes for money paid to credit purchases to leave. So the total left is now the amount of so the total left is now the cash conversion cycle. So now we're going to look at one more formula under this activity ratio, and that formula is called the ratio of inventory turnover. And the formula for ratio of inventory turnover is equals to cost of sales divided by average inventory. So this formula basically is the number of times average inventory converts into sales. So this formula measures how many times you bring in new inventory in the year. So the number of times average inventory converts into sales. That's what this formula is for. And this is cost of sales divided by the average inventory. And average inventory is gotten by the opening inventory plus the closing inventory divided by 2. Right, so that's clear. So next we're going to look at liquidity ratios. Thank you everyone for watching this video. To watch the next video based on the calculation of the topic we just treated, click on the left button that says watch next, and to check out our previous video based on our suggestions, click on the right button. Please ensure you subscribe for more, like this video, and leave something for us in the comment section. We're waiting for you to reply. Thanks for watching.